This webinar examines the impact of the current political situation in Italy on European debt crisis. Number 1. The Italian parliament recently approved economic package that would entail reduction of debt. As a consequence, the former Italian Prime Minister Berlusconi resigned. The Italian bond registered a very high yield of 7%, reflecting risks to an over-indebted Italian economy. People in Italy celebrated departure of one of the longest term of premiership in Italian history. More important, people identify the current stagnant economy and state structure of Italy to the unprogressive rule of Berlusconi. Number 2. The change in Italy followed exit of the Greek Prime Minister. From the economic perspective, these changes are positive insofar that the new governments in Greece and Italy are committed to austerity measures to restore gross fiscal imbalances. The induction of new Prime Minister has calm down anxiety about high yield of Italian bonds. Number 3. The global capital markets remain hypersensitive to Greek and Italian debt situations. The European debt situation is impacting the global economy substantially. In my opinion, it will be naive to assume that the exit of two prime ministers in Italy and Greece will automatically restore economic balance. The reality is that the structural adjustment measures to cut down debt are unpopular and will be taken by the middle class with a grain of salt. The growing risk is that any political turmoil can sabotage economic reforms, defeating the complete objective of European Central Bank.